Hi, good afternoon, everyone. It's Terry Gardner from CJ Lawrence on Wednesday, February 24th, with some market commentary coming to you today from the CJ Lawrence satellite office. Looking forward to getting back outside soon for some outdoor market commentaries. But today we want to cover 5 topics. First, we want to take a look to see what has changed in the market environment since the beginning of the year. Secondly, we want to talk about the market playbook. Third, we want to go inside the market, below the index level, and see what is taking place at the industry and sub-industry group levels. And fourth, we want to make the point today that winners can keep winning. Finally, we're going to wrap up with a discussion of previous interest rate cycles and whether or not a rising rate environment is more bark than bite for stock prices. So first off, what's changed in the new year? Well, clearly the interest rate and inflation expectations environment has changed. The 10-year U.S. Treasury yield is now hovering around 1.4%. That's well above where it was in the third and fourth quarter of last year. And it's not necessarily the absolute level that bothers the market. It tends to be the rate of change. So while 1.4, 1.5% is still near 50-year historical lows, the 10-year Treasury yield is up 55 basis points in just the last 3 months, and that's a rapid rise. And while inflation has been tame for the past decade, we're starting to see signs that inflation and inflation expectations, which really matter to the market, are creeping higher. In fact, we're starting to see 2021 and 2022 forecast eclipse 2% for the first time in several years. So that's something that bears watching. So what does that all mean for the stock market? Well, that's kind of leads us to our point number 2, that the market follows a playbook. The market oftentimes follows a big if-then logic statement. If the macro environment changes, then the following rotations take place and asset allocation adjustments take place. And I think that's what we're seeing some of now. And sometimes those adjustments, those shifts, those rotations happen without much consideration for the underlying fundamentals of the underlying groups and companies in the indices. The point that I'm also trying to make is that the market has shifted over the last several years towards passive investing, although it may be shifting back. Bank of America Merrill Lynch, in a study last year, suggested that 45 to 50% of the average volume on the U.S. exchanges traded daily is controlled by passive investment vehicles, whether they be ETFs or investment funds. That has ramifications for underlying securities, because when you get these big shifts, when you get changes in the macro, when interest rates start to rise, inflation expectations start to rise, that triggers asset allocation shifts, sector rotations, style shifts from growth to value that have impact on the underlying securities. And we may be seeing some of that in the market today. So we're going to, as our next point, we're going to take a look underneath the index level to see what is happening with groups and with sub-industry groups and industry groups. So we did some analysis of the S&P 500. As we talk on our videos regularly, we typically look at the 11 major sectors of the S&P 500. For this analysis, we went down to the 64 industry groups, and then I think there's 147 sub-industry groups, to see where the flows were shifting in and out of these groups. And there were some interesting takeaways from the analysis when I look at the top of the list of year-to-date performers. Actually, let me back up a step. Not year-to-date, but what we did was we started this analysis on January 27th. Why the 27th? Because the year started with interest rates creeping a little bit higher than 1% at the 10-year government bond level. Started to fall back again, and on January 27th, the 10-year government bond kissed 1% and shot higher and hasn't looked back. So if you start the analysis on the 27th, it gives you a pretty interesting picture of what the downstream impacts are on the different S&P groups and sub-industry groups. And with regard to their fundamentals, when I look at the top of the list of performance, so since January 27th, you see groups at the top of the list like casinos and gaming, up 35% for the year. despite the fact that earnings for that group are supposed to decline, will be 11% below where they were even in 2019. So that's that 2-year stack we talk about. We kind of threw out 2020 and said, okay, what do earnings look like in 2021 versus 2019 as a baseline? And earnings will be below 2019 levels in that group by 11%. Hotels, resorts, cruise lines, that group is up 29% since January 27th, despite the fact that earnings on that 2-year stack will be down 30%. Other industry groups, airlines, similar, up 27% for the price. Earnings expectations down 30% on the 2-year analysis. And I can go through a number of others. There's a lot of oil and gas names at the top of the list, typically following oil prices and natural gas prices, but also getting a lift because the expectation is that as the economy recovers, consumption will rise, perhaps outstripping demand. Oil prices will continue to rise, and these companies will make money. So they've done, particularly well in the beginning of this year. As have banks. Banks as a group up 19% in price and expecting 30% increase in earnings over that 2-year stack. What does it look like at the other end? What groups, what sub-industry groups, what industry groups are lagging or even gone negative for the year? A couple are interesting, I think. The Internet and Direct Marketing Retail group, which contains Amazon, is flat for the year, despite the fact that that earnings stack, 21 over 19, is up 53%. Also, down for the year, Life Science Tools, down slightly, earnings expected to grow 50%. And there's a few others. So what you've seen is the buyers come in and swoop up a bunch of industry groups, sectors that have underperformed, but according to the playbook, should do well as the economy recovers, despite the fact the fundamentals underlying many of these companies are poor. What does that create? It creates an opportunity for active investors like we are at CJ Lawrence to find names that are that have sold off based on the rotation, based on the shift, that have excellent fundamentals that we want to own and own for the long term. So this becomes the dichotomy between a sector and a rotation trade versus an investment. The market is trading, it's shifting, but it's also creating great investment opportunities for longer term focused investors. So that analysis is available if you're interested. The fourth point that we wanted to make in our video today is that winners can keep on winning. So it's oftentimes points like this in the market where investors will say you've made a lot of money in this particular stock or this particular group, and they want to sell them and rotate into something else that hasn't yet worked that may for the next leg. There's nothing wrong with trimming positions and rebalancing portfolios. That makes a ton of sense to us. We certainly do it. But we do caution others about selling winners when they can keep winning. And so we took a look at two past recent spikes in interest rates to see how stocks did and to see what groups, what sectors led the market during those two periods. More recently, and I think this is appropriate because these are very recent periods. Again, we're looking at the 10-year Treasury bond yield. And in the period between July 8th, 2016 and December 16th, 2016, so kind of the back half of 2016, the 10-year government bond yield went from 1.36 to 2.55. You would expect that the market would struggle during that jump in interest rates. But in fact, over the 12-month period from the beginning of that move, the market, the S&P 500, returned 13.2%. The next period we looked at was September 8th, 2017 to October 5th, 2018. During that period, the 10-year Treasury yield rose from 2.04% to 3.23%. It's remarkable. We're complaining about 1.5% government bond yields on the 10-year when in 2017 and 18 they were over 3%. But that's where we are. So during that period, again, 2.04% to 3.23%, you would think that that rise in bond yields would really needle the market. And instead, the S&P 500 during the 12-month period from the beginning of that move in interest rates was up 9.5%. What were the leaders during those periods? Again, rising rate environments, or at least spiking rate environments. During both periods, the best performing sectors over the 12-month period, they may have struggled in month 1, 2, 3, and even 4, but over 12 months, the best performing sectors were number 1, technology, and number 2, consumer discretionary, which is heavily weighted towards Amazon. So winners can keep winning. And if you want to draw a football analogy to it, while I was never a Tom Brady fan because I'm a long-suffering New York Jets fan, look at Tom Brady and Rob Gronkowski in the Super Bowl, right? Those are guys that people had kind of cast away as being yesterday's winners. Well, guess what? Winners kept winning. So that's point number 4, which brings me to my final point about interest rates environments. And I'm just going to defer on this point to a piece that we wrote in October of 2018. If you go to our website, you'll find a market comment that I wrote, again, October 9th. And it is an analysis of past interest rate cycles. There are Fed funds hike cycles, so not necessarily tied to the 10-year Treasury, which is controlled by the market, but looking at Fed tightening periods. But I think there's some important parallels that we can draw. And in that analysis, I went through every rate cycle back to the 1930s to look at what happened as rates rose to stock prices during that period. And I think it's interesting analysis and important to consider as we look to higher rates in the current environment. So that's what we've got for today. Certainly, it's a good time to add some cyclical exposure, especially with companies that are industry leaders and innovators in cyclical industries. We're certainly looking at them. It is awfully nice to have an innovator that has wind in their sail from the economy as well. But we want to maintain that healthy growth weighting as well, owning market share, gainers, and disruptors. So if you've got any questions about the analysis that I shared with you today, feel free to reach out to me. My email is tgardner@cjlawrence.com, or you can give me a ring at 212-888-6403. Again, it's Terry Gardner from CJ Lawrence. Hope you have a great evening. Thanks.